Hey everyone, we're just experiencing a couple of we're experiencing a couple of issues on the technical side. We'll get started here in a minute, and look forward to sharing with you the 5 tips on tax tips on getting ready to sell your business. So just bear with us for a minute. We'll jump right back on. Thank you. All right, so Mike will be joining us here shortly. He's going to be our guest speaker or presenter today. I'm actually really excited because I've known Mike for a while, and we work together on several things. I've referred to him on getting people that need a lot of accounting or fractional CFO help. He also has, and I'll say this to him, he's a glutton for punishment because he both has a law degree and an accounting degree. So he's gone to a lot of school, clearly likes to read, clearly likes numbers. So what we're going to do, though, is jump into the legal portion first. I always give a brief update on things that are happening. I'm going to go ahead and do that now. So first up, as you can see on our slides here, I'm going to go to the disclaimer. If I can work my slides today, I don't know what's going on, but we'll just go this way. So disclaimer, obviously, if you have any information that's directly relevant to you, your facts may be different. Please come and ask us questions specifically so we can answer those. Otherwise, this will be generic or general information that can be used, but not specific to your situation. I guess the other thing is both Mike and I are attorneys, so anything we share today is not meant to create an attorney-client privilege. We are not here to advise you as your counsel at this time. So again, if you need help, let us know. A lot of people, a lot of business owners have been calling, asking about the vaccine mandate. President Biden obviously came on to the news recently and said that all people, all employees are going to get a vaccine. I'm generalizing or paraphrasing a little bit, but there's been a lot of people who have interpreted it that way, and that's why we've been getting a lot of calls relating to that. So really what I want to do first is just break it into 2 parts. When President Biden issued, he has one part which is a mandate, the other part which is a request for rulemaking by the Department of Labor. The federal government has the ability to do things for those that they currently employ. The federal government is a large employer, if you think of them like that. So they have requested and mandated that their employees receive the vaccine. There was a suggestion of about 75 days from the date that President Biden was issuing his mandate. The other part is the people who receive federal funds, who are not directly employees of the federal government, but who do receive federal funds from the federal government. So you kind of have a hook in there by the federal government that says, hey, if you want to keep receiving these funds, in theory, then we need you to do certain things. And this is not new to the vaccine. People shouldn't get up in arms about that. There's always been contingencies for people that receive federal funds. They have to do certain things. So that's the other part, and that's where the Health and Human Services, Department of Health and Human Services is actually issuing a rule, in a sense, where they're going to require individuals who receive those federal funds in certain industries to receive the vaccine within a time frame here coming shortly. The last part, which is really the biggest part, I don't represent anybody that's a federal employer. Obviously, I don't represent the federal government, so I don't do that. The second part, we do help people who do receive some federal funds, but we can talk through those and make sure they're squared away. The bigger portion of my practice is relating to those who are private employers, people who do not receive federal funds, people who are not obviously the federal government employing people. That's where this last portion is, which is the private sector. This is where you get into, President Biden may have said, hey, I want everybody to get a vaccine, or all employers to require their employees to get a vaccine or to be tested once a week. But that actually has to go through what's called a rulemaking process. And sometimes a rulemaking process can take 1, 2, 3 years because you're supposed to get feedback and buy-in from other interested groups. This is called an emergency rulemaking process. which there's anticipated, 45 to 60-day time frame for this rule to come out. I'm going to guess, and I talked to Mike previously about this, I'm going to guess that this rulemaking is going to have some stumbling blocks. There's going to be interested parties that are coming in, whether to defeat it or to clarify. I think there's a lot of clarification that would need to come. And after the rule actually is implemented or goes into effect, there's always a grace period for which those people have to start actually complying with the rule. And in that time frame, there's typically lawsuits that come. You saw this when President Obama was trying to increase the salary limit on the overtime exemption. And what happened was these interested parties or groups will find or pursue litigation in federal district courts in states where, frankly, it's more friendly to them. So that one, particularly with President Obama and the wage limit increase, it was a lawsuit brought in the Federal District Court of Texas. And the district court judge there said, hey, halt this. It's not, the proper process has not been followed by the Department of Labor. We're gonna have to go back to step one. And I'm gonna guess here that that's likely what will happen. I would guess the lawsuit again will be brought in Texas, but we don't know yet. We're gonna see. The thing that a lot of people have been concerned about is, hey, if I don't comply, what's the threatened issues that I will face? What's the threatened penalties I will face? On its face, President Biden, you see some White House direction or directives. They said that they are trying to push a $14,000 penalty per violation. Again, that hasn't been outlined in strict regulation, but that's an interesting kind of number. I mean, if you, that's pretty severe, pretty steep. As I said, for the private employees, or sorry, private employers, there's a lot of things that haven't been defined. So one of the things is there's been a request for any employer with more than 100 employees to either require the vaccine or have testing. Well, does that mean 100 employees in a specific location or just 100 employees that the company has generally? Because that can be a big difference. Secondly, who bears the cost of the testing? If somebody does not want to get vaccinated as an employee, does the employer have to bear the cost of the employee getting tested? A lot of times when you do drug testing, that's the case, or is it going to be the employee? Obviously, from the employer side, that's a huge difference on cost, especially if you're looking at having 100 or more employees, which is who this would apply to. The third is what happens if people don't, people still fall under those subject non-discriminatory practices where they either have a ADA, which is an Americans with Disabilities Act, a disability that can alleviate their need for the vaccine or alleviate if they got it would be worse for them, or two, a religious exemption. There's been talks that this would not obviously factor into those people, but you have to think if they aren't going to be vaccinated, then they probably will need to be tested weekly. And again, you jump into, well, whose responsibility is that? If it's no fault of the employee for not getting vaccinated because of a religious or disability reason, and it's no fault of the employer that they can't get vaccinated, there's a cost factor there. So these things are still coming out. The thing that I talk to people about is always use best practices. Communication is critical. One of the things that we've done is created a couple of different policies for different employers. Some have already implemented mandatory vaccines. Some have said, hey, you know what? We don't mandate it, but we strongly encourage. And others have different procedures. If you aren't vaccinated, these are the things that we just need you to comply with. So if that seems to fit where you're at, you have one of those three feelings towards this issue, let me know. We'd be happy to help you with it. In all honesty, I think there's a lot of emotionally charged feelings that come about with President Biden even saying that there was going to be a mandate. And so I think that's what we're fielding a lot of calls on, is just making sure people understand there's nothing that impacts you currently in most cases. So let's just take a step back and let's watch this process move along, and we'll keep you updated on what needs to happen and when. So I'm going to move over to, let's see if I can bring in Mike real quick. I see that he's on. And I'm going to unmute. Let's see if I can make him a co-host.
Hey, Tim, I'm here. I think just need you. Here we go. Got some video about this.
Excellent. Well, hey, Mike, how you doing?
Good, good. Thanks for having me on. It's great to be with you, Tim.
Yeah, it's funny. I always joke. As you can see, my PowerPoint's not even in the display. I've got three monitors going right now, and when I tried to pop it up, it just my tech savvy was not keen right now. So no worries on your end, Mike. We just appreciate having you for the time that we have you. I gave you a little intro, but I'll do a little more here. Mike has a unique background. He does both accounting and law. He went and worked for a Big Four accounting firm in their nonprofit sector, has done other things with accounting, and is very sharp on the accounting side. And I think that's been a huge benefit to his clients. Like me, he has kind of a progressive mindset towards accounting, and in small part in his practice, he does the law as well, and very well. But he has a very progressive mindset, and really what he's focusing on is not, hey, how can I make money? It's really, how can I help my clients be successful? Because when they're successful, everybody's successful. And Mike set up a program where you have three tiers to his accounting practice: a bookkeeping, accounting, and fractional CFO. They're very strategic in what they present and how they do it, knowledgeable. I've sent several clients over to Mike and his team and really appreciated what he's done. I already told him, Mike, that you're a glutton for punishment because you went through both accounting and law school. Most people would want to throw up at either of those, but you did both. So I don't know if that makes you a hero or insane, but either way, we're glad to have you on today.
Yeah, and I appreciate it, Tim. I kind of was in that time of life where I couldn't make a decision, so I decided just to stay in school. It was a better than prison, and it worked out okay. So yeah, and I appreciate the introduction. We've enjoyed our relationship with you as well. I've known Tim since law school and professionally. We've each in a couple of different roles have been able to associate and work together in different ways. So yeah, our background, our firm, we do both tax and legal services and accounting services. I had told you before, there's a reason I'm now bald. Nothing to do with genetics. It's just a matter of putting on the CPA hat and then taking it off and putting the law hat on and switching back and forth so much that tends to wear in your head. So want to jump in. You have there we go, slide here. So Tim asked me to jump in and talk through some tax tips when selling your business. Tim and I, this is one of the practice areas that we share. So Tim, whatever input you have, I know that you're one of my go-tos when it comes to structuring deals and you know, getting advice. And I think we've been able to help each other with that.
Let me just say this, Mike, real quick. The reason that we're even bringing this up, this is one of those topics that we thought, oh, it'd be nice to have. This has been a topic that has been asked by countless small to mid-sized businesses that we represent that are in the growing phase. A lot of them are maybe 2 years, 3 years out. Mike will talk about that, but a lot of them are saying, hey, I'm looking at sooner than later. And so this is a really critical topic, critical information that we can share. And that's why I really am excited to have you on, Mike. Another thing I'll just plant for you is I know a lot of people on my side as well as yours have felt that they need to sell their business before the end of this year because of some potential President Biden tax law changes. So I'll just lead with that and let you kind of take the ball from there and interject as needed.
Yeah, people are we're getting that question a lot, and I think most people are probably overstating. You know, we don't quite know. In fact, Congress, as of right now, is in their second day of debating the House Ways and Means proposal that came out late last week, and so that legislation is literally being crafted as we speak. Our prediction is that tax rates will go up, which again, you know, if you're running a business, that's going to affect you. Also, if you're employed, that's going to affect you. But we also think that for the most part, there's going to be a little bit less of an impact on most Americans that are in the middle class. A lot of the provisions that we've seen proposed are going to be for the high income earners and high income taxpayers. And so that's all to be seen. You know, another reason I think that your sentiment has rung true in our practice as well, not only because of the Biden tax proposal, but because of the effect that COVID has had on business owners. most of the business owners that we work with, and that's kind of our niche, we really love to work with business owners, understand what they do in their business, but also how that affects them personally. They're either in one of two camps. They're either completely run down because their business has just taken off and they've been so busy they haven't had a chance to breathe, or alternatively, that a handful of industries have been, kind of squeaked dry and just don't have the ability to run their business at their full capacity because of COVID. Fortunately, most of our clients have been in the first group, but it does wear on you. And I know a lot of people are looking at exit options, which, kind of one thing I want to cover today is as the 7 habits of highly effective people would suggest, is to begin with the end in mind. So when you start a business, and frequently, I'm sure you have the same conversation with your clients, Tim, is know what your exit options are before you start, and make some goals. If your goal is to run this as a family business and keep in the family forever, then that's a lot different outlook, and it's going to change the way you do your business than if you were to, basically try to build up a business and sell it in 2 to 3 years. So one thing that, and my first recommendation, and this is again a combination of tax and legal and accounting advice. First piece here is just keep your books squeaky clean.
Yeah.
A lot of business owners that we work with, especially I'd say the construction industry, is kind of notorious for being very highly focused on their core business, which is, building, roofing, HVAC, whatever it might be, plumbing, but they focus less on the accounting and bookkeeping and business side of things. And that's because it's a very busy time right now, especially in Arizona with construction, and they can't, there's not enough hours in the day. But I'll tell you this, there's nothing that damages the trust in a potential buyer quicker than having a set of books that comes in, say in a shoebox. It's got handwriting on it, the formatting's weird, the numbers don't tie, nothing, there's no actual bank statements or any tax forms provided. It's just kind of an estimate in some ways. And as a buyer, it's just cringeworthy. You run away from that type of business, because that business owner, either if the books aren't correct, or they haven't taken time to hire somebody competent to run those books. I would say, on a related note, just take some time. If you're in the boat of, and presumably a lot of people on this webinar, either are currently running businesses, or maybe you're even in the boat where you're preparing to sell or thinking about selling. You can do a lot before you have the conversation with the buyer, before you go to market, to learn about the process. My recommendation is to surround yourself with competent advisors. That would be a lawyer, a CPA, maybe a business broker, unless you have the ability to sell your business without help like that. Any of those people should be able to help you get an understanding of what the buyers are going to ask for. And so what I would do is start putting together a due diligence list. So just a checklist of all the things that the buyers are going to ask for, so that when they ask the questions, you've already thought through your answers, and you have a very prepared response and well thought out response. With the key question you're going to get over and over as you look to sell your business is, why are you selling your business? If it's so profitable, if it's such a hot commodity that you want me to pay so much money for, why are you selling it? And that's the answer. You have to be ready for that, and you have to be ready to dig in there. If your answer to that question is, I don't like where the industry is going. I have terrible customers. My employees are not trustworthy, and we're losing money left and right, and we have tax debt and lawsuits. That's going to be a red flag. So be ready to talk about, the positive things. I'm moving on to, I'm going to retire. I found another opportunity, whatever the case might be. Make sure you answer the question truthfully, but also in a way that won't scare off potential buyers.
Mike, I think that interjects into your second point, which is on that inventory side. You almost have to, when you're saying, create a due diligence list, it's both to see what is going to be presented to you by the outside party, but then also secondly, to say, okay, what is it that I need to take account of? And it does take time. And I think if both Mike and I are small business owners, and the word time is such a, oh, it's cherished, it's hated, it's all the same, it's all those things, because time is really the biggest limitation a lot of times in what you're trying to accomplish. And
Yep.
so I think when we hear those things, hey, I've got to take a lot of time, to get your book squeaky clean, Mike, what's the best way for somebody to do that if they don't have a ton of time?
Yeah, get some help. There's plenty of bookkeepers. It doesn't have to be in person. There's lots of systems that will allow you to have somebody remote in and take care of your books, provide some basic documents that they can help you with that. With the second question here, what skeletons are hiding in the closet? A prepared and an experienced buyer counsel is going to help the buyer either directly find the skeletons, or at least look for indications that there are skeletons in the closet. So you really want to be able to understand, when you provide a balance sheet to somebody, what assets are on there, what liabilities are on there, and are these current? Do we have old trucks and trailers on there that haven't been actually on site for 30 years? Do we have a photocopier and a generation 1 Macintosh computer, or are we keeping that up to date, right? It's all an indication of the degree to which you're keeping your business accurate.
And Mike, let me interject there as well. I think what you're referencing too is a lot of people, they go to their accountant once a year or maybe a couple times, but the accountant really looks at last year's tax returns to pull assets for depreciation and other things like that. And you'll get asked the question often, hey, anything changed? And in your mind, you haven't done an inventory, so the answer is no. So to that point, I think you're saying, hey, it does take that effort to go in and say, what is it? Where are we at? What assets do we have? Is that what you've seen too with people and trailers and trucks and stuff, where it's just literally the same thing's been on the depreciation list for a long time?
Yeah, people tend to focus on the income side because that's what triggers the amount of tax you're going to pay in a certain year. But when you have a set of books, which is that's your financial statements from QuickBooks usually, and if that doesn't match what's on the filed tax return, which remember a tax return is filed under penalty of perjury, and so if you have a tax return that shows different than what's on the books, that's going to be a big red flag for a buyer. And so yeah, just take the time to walk around, literally physically inventory what assets do we have, which ones need to be removed. Do all of this before anybody comes in and takes a peek under the hood. The critical piece with the assets and liabilities is that's going to this is not a decision you're going to need to make as the seller. This is something your counsel will help you with, is the structure of the sale. So the two general types of sale, there's the asset sale, and then there's the stock sale, which if it's an LLC, it's going to be a membership interest sale. We'll just call it a sale of the business equity. So typically the seller is going to want a stock sale for a couple of reasons. Number one, it normally always results in capital gains as opposed to ordinary income. Capital gains, at least currently until something changes, are taxed at a lower rate than ordinary income. Also, if you are selling the stock of your company, you're typically going to be able to walk away from any potential liabilities, lawsuits, debt, unknown, uncertain claims. Whereas the buyer typically wants to do an asset sale because they'll be able to come in, and from a tax perspective, it's very advantageous for the buyer to come in. And if there are assets that have already been depreciated, so again, trucks, real estate, et cetera, they can come in and get a new basis. They can take additional depreciation expense. Understand, and this is where you need, again, get some help. What are the hot assets? And those are the ones that are going to cause additional tax as the seller if you're doing an asset sale. So depreciated assets like vehicles, computers, accounts receivable, and inventory. Those are the ones that you really need to look out for. If my advice is always, when I'm representing somebody on a sale, we always try to, or on a purchase, we always try to bring the terms first. So we set the structure that way. Later, if there's a negotiation and they want to change the actual structure from an asset to a stock sale, they've got to kind of give us some something back in exchange because the negotiation's already been set with that expectation. The liabilities is also very critically important. There could be some tax implications there. There's also legal, obligations. So again, if you're doing an asset sale, you're going to keep the business's name. You're just selling, you're kind of just defunding, taking away all the assets out of the business, but the name stays with you. The LLC stays with you. Whereas with a stock sale, you're just changing the owner, but the existing entity stays in place with all of the assets under it. And so if there's a lawsuit from a vendor, or if there's a customer that's upset or wants a refund from something that happened before the purchase, under a stock sale, typically it's going to be very easy for them to go after the company itself. Whereas under an asset sale, there's going to be an additional hurdle because that company may not even be in business anymore, and the assets were moved to a different LLC. And I know I'm cutting a little bit on time, so I'm going to buzz through 3 through 5. They're all kind of related. One thing that you really need to understand is specific to your industry. What is the standard for indicating value? So in a service-based industry, for example, for accountants and lawyers, a lot of times you start with 1 times gross revenue. So a business accounting firm that does $800,000 a year in gross revenue, that's going to be the starting purchase price. Now, again, every company is different. There's going to be things that are going to discount that value or are going to add a premium to that value. But you need to understand what drives that value so that when that offer comes through, you'll know how does that fall on the reasonableness scale. There's publications out there. Any professional that deals with this will be able to give you at least a back of the napkin. Recommendation is to the extent it makes sense, always make it. It usually is good to get some sort of business valuation done. Other companies are not based on gross revenue, but they're based on a sale of EBITDA. So EBITDA means earnings before interest, taxes, depreciation, and amortization. And it's essentially the net cash flow to the owner. And so you'll hear the word multiple. So this business sold at a 2x multiple, a 3x, a 4x multiple. That just means, as a general statement, the net cash flow to the owner. So at a $800,000 business that has $500,000 of expenses is going to have net cash flow to the owner of $300,000. And if that is going to go for a 3x multiple, that's going to be a $900,000 starting sales price, and then it can go up and down from there. So industry specific for sure, but there are some things that you can do, regardless of the industry, to make sure that you're maximizing your value. The one that is industry agnostic is the degree to which the owner or the owners are personally involved in running the business. So if you have a business that is running itself and the owner is able to take vacations and have a balanced life and spend time with their family and coach football and do all these things and not have to be at their desk or in their truck 90 hours a week, that business is going to be attractive to a buyer. If the business is so dependent on the personal efforts of the owner that the business wouldn't succeed without somebody coming in to replace them, then that's going to be, maybe not be, a hard worker is not going to be necessarily afraid of that, but they're going to want a lower purchase price for that because they're going to have to personally replicate your same efforts, or they're going to have to hire somebody to do the things that you were doing.
Yeah.
So 4th point, just be flexible in the timing and the structure. This is, from a tax perspective, if you can spread the income out over 2 tax years, you're going to stay in a lower tax bracket for each of those years than if you had sold it all in 1 tax year. And then, there may be other ways to structure the payments. Maybe it's not always just cash. Maybe there's some debt relief. Maybe there's some assets that you want. Maybe there's a real estate aspect where you can trade real estate back and forth and lower your taxable gain. So, also there might be things you can do with your continued efforts. So they're going to pay you the purchase price, but then they're going to pay you as the seller to stay on for a month or 2 months or 3 months, pay you a hefty salary to help with the transition. Be open to things like that, because that can be, pretty easy work. You're already used to doing this. The buyer's in a state where they need all the help they can get, and there's no better person to help them with the transition than the person that's been running the business or built the business. And to wrap up, Tim, tell me if I'm low or high on time here, but
you're doing great.
Yeah, I would say just don't rush with this process. Time is your friend. If it's possible, we always advise our clients, start thinking about this 2 years ahead of time. That's a long runway, but what that allows you to do is to get all of your own house in order before you start showing it to the public, right? Think of the analogy as selling your home and having open house. And people are going to come into your home. They're going to look into your closet. They're going to peek in your garage. They're going to open your junk drawer. They're going to look in your toilet, and they're going to see some things that maybe you didn't want them to see. So take some time to clean those things up. If there's a lender involved with a business, that the business that is buying, or the individual buying your business needs to get a loan, they're going to want to see 2 years of good financial statements and 2 years of good tax returns. So if you can start thinking about this now, and really just make sure that everything's in order, there's a long history, that you as your owner yourself, establish some balance in your life. And even if it means a little bit lower profit margin now, the fact that you only work 20 hours a week and you had a profitable business goes a long way. The last point of that is on the rush standpoint. A lot of times this doesn't necessarily come up as you're intentionally going to market to sell your business, right? It's rather you get approached. You may get approached from a competitor, you get approached from an employee, or from somebody else that just says, I love what you're doing. I want to buy this, and then all of a sudden you're in a kind of a very sudden mindset of what does it mean to sell a business, and you might take that first offer and it might be grossly undervalued. So don't rush that process either. Not to say don't take the first offer, but just don't rush on it. Let the process develop. It's good to create some competition, get some additional buyers, get some additional competition to the table, and see what's your business worth. So those are my main points. There's obviously a lot of there's a lot of depth behind all of those areas, but I'm happy. I'm sure Tim will provide contact information. He knows how to get a hold of me. I'm so happy to talk with anybody if you're having specific questions on selling your business and the tax implications.
That's absolutely, I appreciate that, Mike. We're going to run through a couple scenarios just to walk through some things that people see often. On your point of it being like an open house, I think that's most people, you see a lot of these companies that are coming out right now and buying homes for cash for way under price what somebody could get, but because that doesn't happen as much in business, because homes have property which are valuable, right? So a home has some level of inherent value, whether you have to gut it or not. Whereas a business, really your books, if I was to correspond with anything, your taxes, your books are the foundational piece of how you value something. So a lot of people are a little scared to lean into, I haven't done my books. I don't want to have to think about it. I don't want to have to get them up to speed. Mike has a pretty simple process. There is some cost. It's not excessive, but he has a process where if you haven't done your books, guess what? We can get you up to speed. And it's something that as a business owner, you really have to lean into. So that is my dog. Hope you enjoy hearing some barking in the background for the next minute, but let's run through a couple scenarios, Mike.
Yeah, let's hope my dog doesn't stop barking because I'm at the office. That's scary.
Well, it's always fun to have a dog barking. It just adds a little comedy. All right, so Mike, this is a scenario we talked about a little bit. You've already addressed a little bit, but let's just go through it real quick. Carlos and Emily have had huge success in their service company over the last 3 years. They've never kept great books, but they've always made money, and now they're ready to sell their business. What tax issues are Carlos and Emily going to run into when trying to sell their business? And I really should say, what accounting and tax issues are they going to run into when approaching this potential buyer?
Yeah, they're going to have to do either do a bunch of cleanup, or they're going to have to find a buyer that is okay with that uncertainty. From the buyer perspective, I'm always concerned about any outstanding tax liabilities. So if you're telling me they haven't kept great books, I know they've had to file their tax returns because that's required by law. And if they haven't, then that's a really big red flag. But that's my number one is, hey, if your books aren't in shape, you now have misrepresentations to the IRS, which are going to cause potentially big problems for somebody walking in. And you don't, as the buyer, good luck finding, getting the seller to come back and answer questions. They don't really have a reason to after they get paid out. And now it becomes your problem if you don't address it before it closes.
This would almost more than likely be an asset purchase if you had this issue where somebody didn't have great books. Your value, I think you talked about on the purchase side, goes way down, because when you have uncertainty, if you've learned one thing in business, certainty is king. And if you have uncertainty and things as big as your books, then yeah, that's going to be an issue. To that point, Mike, you guys go back and help people correct their books. I mean, I've seen it. You'll go back and help people refile tax returns. So it's not insurmountable. That's kind of what I want to give people, is that hope and encouragement. Like, hey, it's a great process. Don't run away from it. If you're ready, I was telling some people the other day, 2 or 3 out of 5 people just simply walk away from their business when they're done. They don't want to put the effort in to sell it. They don't want to put their, get their books up to speed or something like that. So they literally let their biggest asset and biggest time expense in their life just literally go to waste. Don't do that. We can help. Let's get you on board.
Absolutely.
All right. Next up, Devon is a solo owner operator of his business. A private equity group wants to buy his company, but keep him on as an operator of the company. The private equity company is suggesting that they'll pay Devon some money in the form of a 3-year employment contract versus increasing the purchase price. What tax implications are there, Mike? What should he be considering?
Yeah, so back to the structure of the sale. If you're looking at a 3-year employment contract, that's going to be considered ordinary income to you, and it's also subject to payroll tax. And so that's really the highest possible tax situation. Whereas if he were to sell the business, get some of this money up front, depending on the nature of his assets, usually if it's a sole owner operator, a big chunk of that, if it's an asset sale, is going to be the goodwill. And that's all going to be taxed as a capital gain. Alternatively, if this private equity group likes the business's name, they like the reputation, and they're really looking to continue the business that he has, they might come in as a stock purchase, in which case all of his gain is going to be a capital gain. And so that's great for him. And so you just kind of have to look at, also what is the current year tax rate? We talked about the Biden tax form changes. If I have a client that could recognize a capital gain in 2021 versus higher income, tax rates in the next 3 years, that's going to start to look attractive. And then, what other opportunities do you have to do with that money? Can you invest it in something else? Can you pay, take the hit, pay the tax now, and then at the end of this 3-year period, maybe it's time for you to walk away. Maybe they give you a great offer and you end up staying with this private equity group, but give yourself some options and kind of map it all out beforehand.
Yeah, no, I think your point on exactly that, which is a lot of people I've seen love that feeling of assurance. Ooh, 3 years contract, that's great. They're going to give me some pay on the back end, and yeah, the purchase price, this, that's okay, because they're actually bumping up the purchase price. If I look at it from the point of a 3-year contract, is more than I get just direct on the purchase. All those things, right? The employment contract is not bad, but I wouldn't suggest you use it as an increase or a decrease to your purchase price, because of the reasons Mike just talked about, which is employment wages are the highest taxed form of income you can receive. You have 2 taxation levels on them. The employment wage tax is taxed, and then you have your ordinary income tax. So I love that, Mike. That's great insight. Let's jump to number 3.
And not to mention, kind of delving into your practice here, Tim, as we know, most employment contracts are at will. And so a 3-year employment contract may actually mean nothing, right? Yeah. Unless they're going to guarantee some of that, they could cut you the next week, and then you've got nothing.
It's exactly right. It's exactly right. A lot of them will say 3 years, 5 years, something like that. But then if you look in the termination provisions, it's either 7-day, I've seen 30-day notice, either party, or a lot of times it'll just be the private equity new owner party can give 30-day. You have no out except for them. So, all right, Tiffany's excited to sell her e-commerce business. The buyer is proposing that she do a seller carryback. We've all heard this: owner carryback, seller carryback. versus the buyer using traditional financing? What are the tax benefits or pitfalls of a seller carryback?
Yeah, so this is common. Frequently, you've got some private money coming here, some bank money coming in, and there's some piece that's also a seller carryback. Seller carryback just means the seller is going to allow the buyer to pay them directly and act as the lender. So from a tax standpoint, the good thing about a seller carryback is that it spreads out the purchase price over multiple years, which is a good strategy because it keeps you from having one big income year where it's all taxed at the highest tax rate. On the other hand, you're also getting some interest. Presumably, there's some interest component, so you're getting a return on your money. If you don't need all of that cash up front because you have another planned use for it, it could actually be a lucrative investment. You might get an 8% or 9% return, which is a lot better than, most investments in the stock market are going to be unpredictable. This will be fairly predictable. If you're doing a seller carryback, I always want to make sure that you look at yourself as a lender. Don't just look at yourself as someone who used to own the business, but do all the things that a lender would do to secure your position. So have a promissory note in effect that is an agreement to pay. State the terms clearly. Make sure this is an arm's length transaction that's clearly documented. And then if there are assets in the business, then go ahead and go through the trouble of creating a lien or security filing against those assets, so that if you're the seller and your buyer comes in, wants to do seller carryback, and they may end up just running this business into the ground. Well, you still now, if you've done it right, you're a lender with a security interest in whatever assets they didn't completely blow. So you may just be able to come in, possibly second position to a bank, but whatever's left over, you should be able to come in and repossess those vehicles, take over the business again because they defaulted on their loan to you. So to the extent that they still owe you money, you're entitled to go back in potentially and go take it back over, and it's not a complete loss at that point.
No, that's a good point. I think there's a lot of good things to think through with the seller carryback. There's a lot of good options out there, and then there's also risk that you have to calculate. And if you say, hey, like you said, Mike, hey, it's purposeful and meaningful risk for me to take because the reward is X, Y, Z, and I'm okay with that, and that's great. A lot of people that seem to come for hey, I want to buy a business, or sorry, I want to sell a business. In most instances, what I've seen is they're looking to cash out. But I think there's all different structures. And on the tax side, Mike, you hit a good point, which is sometimes a seller carryback is not a bad thing if you can structure the payments to come over a period of years, because then you can not hit that capital gains threshold so quickly, or not have so much over that threshold to be taxed on.
Yeah, and then from the buyer side, there's different ways to structure things to where if the concern always from the buyer side is, hey, you built this business, you bootstrapped it. If I come in, your customers or clients aren't going to want to stay with me. So you can do some things to, do like an earnout provision or some sort of clawback provision that would then make the future purchase price. So maybe there's a chunk that's paid now, but future payments towards the purchase price are contingent on the business's continued success.
Sure.
So that kind of aligns the buyers and sellers' interests, so that if the buyer's struggling, the seller can come in and reach out to clients and customers and kind of smooth things over, or even go. I've seen sellers take a sales role and they can earn additional money in addition to the purchase price just by working their contacts. And a lot of times, if you've been running a business, that's the easiest part of your job. So if you don't have to run the business, you can just go sell and earn more money. That's an easy role for you.
That makes sense. All right, scenario 4 real quick. A potential buyer wants to buy Craig's business, which has a lot of equipment and machinery. Is it better for Craig to push more of the purchase price towards the equipment cost, or to shift it to just the overall goodwill of the business? What is better? And then we'll ask what's better for the potential buyer. So go ahead, and for Craig, who's selling his business, what's better from a tax perspective here, Mike?
Yeah, it's better for Craig to not get in trouble with the IRS. So instead of presuming that he can really control that. We really want to just be as accurate as possible with valuing the business assets. But at the same time, you're right. There's always some wiggle room. There's always room to say, that John Deere is an old model, and it's not worth much, right? So, but generally, to answer your question, now what we're talking about is under an asset sale structure. These are good examples of two different assets that are taxed differently. So goodwill is going to be taxed as a capital gain, whereas goodwill is kind of the catch-all. We've looked at every component of the business, every desk and computer, and every other element, whether it's tangible or intangible software and intellectual property, and there's just an amount left over because the business has built a reputation, the business has built its good name, the business has just a good feeling about it, momentum. That tends to just be pushed into this goodwill category, which is going to be a capital gain and lower tax to the seller. The equipment is tricky because depending on how long you've had the equipment and how much you've elected to take as depreciation expense, you may need to recognize what's called depreciation recapture, which means if you previously bought a Ford Raptor and you depreciated all of it in the first year, and then you go to sell your business the next year, and one of your assets that you're selling is the Ford Raptor, well, you're going to have to recognize 25% tax, which is going to be higher than your 15% normal capital gain rate. Again, by the time people are watching this, we may never see 15% capital gain rates again. Hopefully those stay in place for some of us poor taxpayers. But at this point, I would say, just be cognizant that different assets have different tax treatments. This is a prime example right here, and this is a very common example, I would say.
That makes sense. And I think you talked about the different structures too with, you could structure from the seller's perspective, it might be better to do an equity purchase versus an asset purchase in these types of things. Is that accurate from a tax perspective?
Yeah, absolutely. And tax and a liability perspective. From a tax perspective, the seller almost always wants the stock sale or the equity sale because it's just you're selling the asset you're selling now is your personal interest in that company. So an LLC membership interest is a property right. It's an asset that you own, which now you can sell that, or you can divide it instead of the actual assets. So simpler for you. You can kind of just wash your hands and walk away, and you get the benefit of all of it being taxed at capital gain rates. Now, if we get in a situation where there's a divide on the buyer really wants an asset sale and the seller really wants a stock sale, there is room to do a tax election that would allow you to do an asset sale, but get the benefits of a stock sale for tax purposes. Under the state law, it would still be treated as an asset sale. So you'd get all of the benefits. Under federal tax law, you would get all the benefits of a stock sale. So that's a complicated situation. That has to be the right types of entities, has to be the right circumstances, but it can be very effective.
Well, that sounds like a good cliffhanger to leave people on.
That's right.
I like it. Well, thank you, Mike. I appreciate it. You have shared with us the 5 tips. There's a lot of things obviously moving around. The biggest thing that I get a takeaway from is, again, don't run away from this. If you're a small business owner, if you know somebody who is small to mid-size that says, man, my taxes, my books, I just don't want to deal with them. You will and you should at some point, and the quicker you do it, the better. And Mike's team at Boss is a really good fit. They do great work, get people back up to speed. And like Mike said, I think we share the same image or same vision, which is we want to get people to where they need to go. And really what people want to do with their business is a lot of times to build it up to either sell or to have it operate independent of them. And that's really our focus. So Mike,
including having your kids take it over for you, Tim.
There you go. Hey, operate it independent of me being my kids would be fine too. That's great. No, I appreciate it, Mike. Thank you, everybody. We're going to go ahead and stop here. If you have any questions, our emails are on this page here, Mike's and mine. If you have questions, please email us. We'd love to answer them. And thank you for coming and joining us today.
Thanks, Tim.
Thank you, Mike. Appreciate it. Oh, there's the end.